Welcome to The Explainer. Today, we're diving straight into the fascinating world of International Financial Reporting Standards, or IFRS, and how they function as the ultimate strategic playbook for global business. But we're actually going to go a step further than just talking about accounting rules. We are going to look under the hood at the operational reality. We're talking about how your ERP, your databases, and your accounting software must actually be structured to make this kind of global compliance possible.
So think about this for a second. How do you actually compare a company in South Africa with one in China? What's really interesting about this question is that without a common framework, comparing disparate national accounting systems is like trying to translate a dozen different languages all at once. You might be looking at two incredibly successful companies, but if their underlying data systems calculate things like revenue or asset depreciation completely differently, well, you have absolutely zero baseline for comparison.
To unpack all of this, we'll break this explainer down into 4 parts.
First, a global financial language. Second, the rules of adoption. Third, core financial statements. And finally, navigating implementation decisions.
All right, part 1, a global financial language. Let's jump in.
You know, the rush toward international convergence has been absolutely massive. Today, more than 100 countries currently subscribe to IFRS. This represents a monumental global shift away from isolated local generally accepted accounting principles, or GAAP. When you consider the sheer volume of multinational transactions happening every single day, millions of data points are finally speaking the exact same dialect.
Basically, IFRS acts like a universal translator. It takes a chaotic web of local standards and transforms it into a single, understandable language for investors and lenders worldwide. But, as we'll see, achieving this fair presentation requires absolute rigor in how you capture and process your underlying data.
Now, this system rests on 4 main pillars: understandability, relevance, reliability, and comparability. These characteristics have to be balanced perfectly to hit that goal of fair presentation. Think about it from a systems perspective. If your ERP is pulling wonky or inconsistent data tables, you literally lose reliability right out of the gate. If your reporting flows change wildly from year to year, you completely lose comparability. This quote really hits the nail on the head. The source material makes a fascinating point here, that no disclosure is actually better than disclosing misleading information. Transparency is the absolute bedrock of market discipline. Your SQL flows and database queries need to surface the actual truth, not obscure it behind some convoluted spreadsheet.
Moving right along to Section 2, the rules of adoption.
So, you've got IFRS 1. Think of this as your transition rulebook. It outlines exactly how to handle the really complex shift from your national GAAP over to international standards. Crucially, it specifically notes this has to be done at a cost that doesn't exceed the benefits. Because, let's be real, ripping and replacing an entire ERP system overnight, that's going to break a company. So the standard provides calculated, manageable pathways for the transition.
Now look at how the timeline breaks down here. There's a really crucial distinction between the transition date and the reporting date. To actually meet IFRS requirements, you need 3 statements of financial position just to hit your first reporting date. From a software perspective, this is huge. Your database cannot simply overwrite your historical data. It has to maintain your old GAAP numbers while simultaneously calculating the new IFRS numbers for comparative periods. When you're building that opening statement, you essentially have to put your historical data through a very strict filter. You recognize new assets, remove non-permitted ones, and reclassify the rest. So, how does your accounting software actually handle this? Well, you definitely don't delete your old base tables. Instead, modern ERPs use a multi-ledger approach or generate specific adjustment rows. This lets the system pull the original GAAP balance, seamlessly apply the IFRS adjustment, and derive the new balance, all without destroying your historical audit trail. Okay, on to Section 3, Core Financial Statements. Right off the bat, you'll spot a terminology shift. The traditional balance sheet is rebranded as the Statement of Financial Position. And this isn't just cosmetic. It reflects a much deeper functional shift towards fair value measurement. This means your chart of accounts within your accounting software actually needs to be meticulously mapped to output these new naming conventions automatically. As you can see from this structural breakdown in the source material, IFRS really shakes up how we report comprehensive income and handle detailed disclosures. Things like share-based payments or asset impairments require highly specific line items. Your data flows literally have to be engineered to isolate and aggregate these things at a moment's notice.
To be fully compliant, your final reporting package needs the whole shebang. You can't just cherry-pick. And critically, those notes containing accounting policies, they are just as important as the raw numbers. Your reporting software has to be sophisticated enough to link the hard quantitative data straight to the qualitative disclosures required to explain the estimates and assumptions your management team made.
Finally, let's wrap things up with Section 4, Navigating Implementation Decisions. This matrix is basically the real-world playbook for executives. Notice that bottom row, determining if accounting systems need updates. To support multiple accounting standards, say maintaining local GAAP for your taxes while reporting IFRS to your global investors, your ERP really needs to be structured using a base ledger paired with parallel adjustment ledgers. The software simply derives the correct view by combining the base transactions with those specific adjustment rows. It gives you incredible flexibility without constantly duplicating your entire database.
The real trick here is making sure your new system captures the super granular data IFRS needs while still looking comparable to the rest of your industry. If your competitors are categorizing certain operational flows one way and your software is too rigidly coded to adapt, you're going to confuse the market. Your system flows must be dynamic enough to map raw transaction data into different presentation buckets as industry practices inevitably evolve.
So as we wrap up this explainer, I really want to leave you pondering this. Are your current data systems truly prepared for a universal standard? Before you kick off this massive transition, look under the hood. Can your infrastructure, your database tables, your SQL queries, and your operational workflows actually handle the multi-layered transparency this language demands? Because at the end of the day, in the world of IFRS, your global financial truth is only ever as reliable as the software engine that builds it.